Investing is so important, man, and the earlier you start, the better. But I just wanted to make a video talking about dividend growth investing. I personally believe dividend growth investing is the best route to go for anyone with a long time horizon. And honestly, even if you start at like 40 years old, you still have a solid chunk of time to let your payments and investments grow. But I like dividend growth so much for several reasons. For starters, let's talk about retirement. One of the biggest fears of most investors is getting to retirement with all the money you have saved up in the S&P 500 and then boom, market crash. All of a sudden, the million you had is now 7 to 800,000. Still not bad, but a pretty steep jump. And you might have to work several more years to get back to where you were when you could have been enjoying retirement with your family. With dividends, you don't have that problem. Don't take it from me. I barely make any money with dividends. Take it from people who actually make money with dividends. Dividendology, someone who I've learned a lot from and mentioned a lot on this channel, has about $200,000 in his investment portfolio. Right now, it pays him about 6 grand a year. And during the market crash, he lost about 25 to $30,000 in his portfolio. But he was still making the exact same amount in dividends. A company isn't just going to stop paying dividends because of a market crash, especially if they've been paying them for a long time and have made a name for themselves within the dividend space. In a similar vein, good companies that have been around aren't just going to go out of business because of a few bad months. But the simple reason they're able to keep paying dividends is because they can afford it. When you have a solid company with consistent cash flow, and even better, a low payout ratio, you're most likely not even going to have to think if you're going to lose out on some dividend income. In the last video, I talked about Constellation Energy. They made around $1 billion in a single quarter, and their entire yearly dividends only cost around 400 million. In one quarter, they made enough to cover their entire yearly dividend multiple times over. Again, you don't have to take this from me. You can look at the stats. In the last video, I talked about Lowe's. They've been paying and raising their dividend for 61 years straight. That was through the 73-74 oil crisis, Black Monday in 1987, the dot-com bubble, the '08 housing market crash, COVID, and more recently, this whole tariff crash situation. So again, you have the ability to lose a significant amount of value in your portfolio, but still make the same in dividends. So you're virtually immune to market crashes. Here's what I don't like about high-paying dividend companies with no dividend growth. The equity curve is basically just a straight line. Yeah, you'll make solid, consistent dividends, but they only go up if you keep putting more money in, and your dividends get eaten up by inflation over time, so really you're making less. If you compare this to dividend growth, where the equity curve may start out low, but eventually goes up and skyrockets like an exponential function, not only will you be able to make more in dividends in the long run compared to high yield but no or low growth, but you can also outpace inflation, which I value so heavily. So you're protecting your money. Now, with that being said, you do need a solid time horizon for this to happen, and I'll show an example in a bit. But first, I wanted to talk about the dividend growth pyramid. When you start learning about dividend growth, you might come across the dividend growth pyramid at some point, and this one from Dividend Growth Investing on YouTube highlights some companies in ETFs at different tiers. And the idea is the bottom pays the highest yield, but has the least amount of growth. And as you go up, the growth gets a lot higher, but the initial yield goes down. With the idea being just a guide, depending on your situation, on companies to invest in. Now, these are pretty much all solid and established companies or ETFs, so investing in any one of these may not be a bad choice. Some closer to the top are very famous in the dividend growth space, like Visa, Lowe's, and SCHD, but in his YouTube video, he gives a quick guideline for the pyramid. These numbers are all arbitrary, but if you have 1 to 3 years till you want to retire, invest in companies at the bottom of the pyramid so you can capitalize on the highest yields. 3 to 5 years, go a step up. 5 to 10 years, go a step up. And then after that is where you start getting really good returns. If you have 10 to 20 years, go a step up into the 9 to 12% growth CAGR range. If you looked at the picture, these are companies like Microsoft and Home Depot, or ETFs like SCHD or DGRO. 20 plus years, and you can go a step up and invest in companies with a 12 plus dividend growth CAGR, Costco, Visa, and Lowe's were shown in this example, and I truly believe they're all great choices, but I think I'm required to say this isn't financial advice. Now, if you are going down the dividend route, I highly urge you to think about using the DRIP method. DRIP stands for Dividend Reinvestment Plan, and it literally just means reinvesting your dividends to purchase more shares. But I'll show you in this example, it can exponentially decrease the amount of time it takes for you to make a certain amount in dividends. But I'd like to show an example to highlight the power of dividend growth investing. I got this from Dividendology. I'm just kind of going over what he did. But this was one of the most insightful videos I've ever seen on the concept of dividend growth. And he basically just used a calculator to simulate 10, 20, 30 years into the future. But he started with a $10,000 investment, a price growth rate of 7%, a dividend growth rate of 8.5%, a dividend yield of 3.5%, and no monthly contributions at all. He was actually kind of basing this off of SHD, and he was being pretty conservative. Both the price growth rate and the dividend growth rate of SHD over the past 10 years have been over 10%. But if you use the DRIP strategy, after 10 years, you'd be making about $100 every single month completely passively. After 20 years, you're making over $300 a month. And at year 23, you'd be making $500 every single month with a total account value of $120,000. Just 5 years later, at year 28, you'd be making $1,000 a month. You would literally be making more every single year than the amount you put in. And if you set it up so all of your dividends got reinvested automatically, you wouldn't even have to look at it after you put in your initial 10K. That is quite literally completely passive income. And if you noticed, you could see the snowball effect start to take place. It took 23 years to make $500 a month, but only 5 to double that. Again, this is assuming you reinvest dividends. If you don't, it would take 30 years and you'd still only be making $300 a month, which, isn't bad, but 30 years for 300 versus 28 for 1,000. The DRIP strategy is looking pretty good. Now, I know this assumes several things, and I know having to wait 20 to 30 years might not sound amazing, but it's just an example of the power of dividend growth. There is a way to slightly combat this, however, and that's by also making monthly contributions. If you contribute $250 a month, assuming the other stats say the exact same, it will only take you 14 years to hit $500 a month. That's almost half the time as the previous example. Still 14 years, but half the time. I highly recommend both of those channels, and I'll link their videos that I referenced, but I just wanted to talk about how awesome dividend growth investing can be. Remember, the earlier the better. But even if you don't have a ton of time, you can still start. And it doesn't even have to be dividend investing. You can just put your money into the S&P 500. But something I also like that I didn't mention is that you don't have to sell any of it. So you can keep your wealth and then pass it on to your family and they can continue earning dividend income. Regardless of your situation and what you choose to do, I wish you luck. If you got anything out of this video, even if it was just something to watch while you ate, consider leaving a comment. I love interacting and having conversations with y'all. We also won this game. I went 15-2.